Welcome to JP Morgan Asset Management's Insights Now. My name is Meera Pandit, and I'm a global market strategist here at JP Morgan. Today, I am joined by my colleague, Katie Korngiebel, a research analyst on our Market Insights team. And we're here to discuss all things equities.
Thanks, Meera. And obviously, one of the major themes so far this year has been the rotation we're seeing within equity markets, maybe long awaited for some, but probably confusing to many. So can you walk us through a bit what's going on there to start?
We've seen a couple of different shades of rotation so far this year. So I'd bucket them into the Mag 7, quality, and also value versus growth. And they're all tied together more or less. So if we start with the Mag 7, it was pretty easy to talk about the markets back in 2023 and 2024 because it was all Mag 7 driving the equity market overall. You had all 7 Mag 7s beating the index in 2023 and about 6 in 2024. Then in 2025, things start to shift a little bit. There's some broadening out in the markets, not only in terms of performance, but also earnings. And then you look at where we are today, and every single Mag 7, as of the time we're recording here, are down and underperforming the index. So huge shift on the Mag 7. Then you look at quality, and through the middle of last year, we had this low-quality rally where everything was rallying and doing pretty well. And it was actually the worst calendar year underperformance for quality since 2003. You start this year, and quality's back. People care about balance sheets, profitability, relative valuations. And then you look at the value versus growth component, and this has been really interesting to see a basically double-digit outperformance so far year to date of value over growth. And the last time we saw this was effectively just around Liberation Day. And at that point, it was volatility, anxiety over tariffs. Right now, it's anxiety over AI. So it does help to protect against volatility. But I also think there's some cyclical factors here. You look at a general easing bias from the Fed, easier monetary policy. We think about the one big beautiful bill, elevated tax refunds. So if you have the fiscal and monetary policy components working, plus you have this momentum from the economy, that's going to help. And then when you think more secularly, you're seeing that maybe there's some skepticism, some cynicism around tech. But then within the AI trade, areas like industrials, materials, this infrastructure layer are still actually doing very well this year. So it's interesting to see that tech is down about 5%, and yet 4 other sectors within the S&P 500 are up double digits.
Yeah, still AI enthusiasm, but people need another outlet for it. They're tired of tech. We're seeing it show up in some of the more second-order plays. Maybe one of the other parts of some of the cyclical rotation we've seen is large cap versus small cap. What are you kind of telling our clients about that?
Yeah, we're seeing that down market cap rotation as well. And when I think about what makes small cap work, if we have an easing bias from the Fed, that tends to be helpful. If we have growth accelerating, that tends to be helpful. And we do expect, because of those elevated tax refunds, growth will accelerate at least for the first half of this year. But we're not at the beginning of a new economic cycle. Some of these fiscal and monetary policy actions have been somewhat distorting in terms of the overall cycle. So if we're not going to see prolonged Fed easing, if we're not going to see a prolonged period of accelerating growth, then you may start to see some of those headwinds creep back in for small cap, especially because small businesses have already been dealing with elevated costs from tariffs and just years of higher inflation, higher wage inflation. You look at higher rates for a number of years, and that also has made the interest burden on small cap, which is primarily reliant on floating rate debt, more challenging. You look at the valuations relative to up market cap, and they are a bit higher and a little bit more challenged from an investor standpoint. And then you look at profitability. I love this stat that you actually helped me with here in terms of what do we expect at the beginning of the year in terms of small cap profitability, and what do we actually end up with? And for 2025, I think you had mentioned 45% was the expectation going into the year. But right now, as we close out the earnings season for 2025, it's something like 7%. So that profitability dynamic is a little bit challenged there ultimately. And you got better profits on the S&P 500. So I think when we're thinking about moving down market cap, areas like mid cap tend to stand up pretty well when you look at both profitability and valuations. Or carve out that niche within small cap value, because some of those value-oriented areas do tend to have that quality dynamic still. And another thing that we have highlighted in our guide is the fact that the analyst coverage per company in small cap is about 3x lower than large cap. So you have like a large cap CEO sneeze and everybody's put in their model.
Yeah.
Whereas with a small cap company, they're not all that well covered. So I think that there's some opportunity there for differentiation. So there are some pockets within small cap and certainly in mid cap that I think look interesting, but just some dynamics to be mindful of.
Yeah, you kind of talked about, a rotation into quality and a rotation into cyclicals, and value can stretch across both. But it sounds like, we're encouraging people without confidence in longer term cyclical tailwinds to kind of focus on that quality aspect of the rotation.
Absolutely, because if some of this stuff starts to fade out into the back half of the year, the Fed maybe doesn't want to cut much more or doesn't want to cut at all. If the economy starts to decelerate back to trend, and not saying recession or slow down, but even if it just gets back to what it was, then some of these areas may have a little bit less of that advantage, and it may look a little bit more tactical in hindsight. Yeah. But what I do want to get back to is let's spend a little bit more time on tech.
Yes.
Because that is the crux of the rotation here that we've seen this year. And I know you've done a lot of work on looking at semis and the hyperscalers in particular, but also digging into the SaaSpocalypse and what's going on in software. So
the SaaSpocalypse.
Yeah, talk to me about what's been going on year to date in tech.
Yeah, I'd say the crux really is software. So that's the biggest detractor on the S&P 500 year to date by a lot. And when we look at that, it's, the constituents, really big major software companies, common names that everyone's heard of, they are down, about 30 to 40% from their peaks in September, October. So that's a massive sell-off, especially for very ingrained companies. I think some of it feels like what you were saying, we're kind of rotating out of tech a little bit. It's a tired trade, and it feels a little like the market's taking their AI angst out on software specifically. But I also do think it's possible that there was somewhat of a catalyst with the progress we've seen in agentic coding. So I think Claude Code is a major advancement that surprised a lot of people. And the movement there is really on the agent side, which is something we've been lacking even from the hyperscalers. So I think it's possible that has triggered a lot of this, and now the concern about agents is making people feel like, oh, well, are we ever going to need enterprise software? Right now, to us, it does look overdone, but obviously there's existential questions about the future of the industry. I think really what we're trying to anchor to here is, the question isn't, can AI help somebody make a better Salesforce? Can it help somebody make a better Intuit? Like, obviously, yes, but I would say the company's moat isn't really that they have this software that can now be redone. It's more, how are these companies, especially the enterprise ones, ingrained into businesses? It's not just places where employees click around buttons. In a lot of cases, it's systems of record. It's integral to, the financial or the operating or the compliance systems of the company. And then there's also a trust factor, right? So cybersecurity, especially on things with compliance, are we ready to outsource that to maybe new AI companies or AI agents entirely? Probably not.
No, and the hierarchy is important, how it's designed, the whole infrastructure behind it, the consistency.
Exactly.
To make sure everybody across the company has a similar general look and feel. And if we want to pull centralized data, then it actually has some organizing factors. So the logic there is important.
Exactly. Like the actual construction of your data, the way that it's organized, where it's sitting, who can pull it. If I'm an individual employee, the AI agent or the software knowing what are my specific permissions versus other people. What should I be able to access? What should I not be able to access? Having all of that context makes data organization even more important. And that's a different kind of software company, right? Like infrastructure software company. So regardless, those should become more important. And then we'll see a lot of disruption in the industry, but we do think how the software is interacting with the business will be crucial. So not all software is dead.
But you did talk about how the cost structure might have to change a little bit. Why is that?
So if we think about software companies traditionally, their costs have scaled with users, right? If I sell more seats, I sell more software licenses, maybe my costs scale a little bit with that. But the reason it's been the poster child for quality is that I can have massive scale without much increase in costs. But now let's say I'm a software company trying to incorporate AI features. Now maybe I'm also not just paying for more users, I'm paying with their usage. So could a couple super users blow my costs out of the water? I think that's, an ongoing question as we see software companies start to incorporate LLM inference into their processes. But as software companies and, specific ones, there's going to be differentiation, prove to the markets, okay, not only are we able to incorporate AI into our existing products, but we're able to get our customers to pay more for them to cover this cost of inference, then I think that could be a catalyst for a turnaround as we see that come through earnings.
A lot of existential questions
Yes.
in tech and everywhere else.
Yes. And I think your other question was about the hyperscalers specifically, which is the other area of focus. And I know you mentioned, they're not doing great this year either. I think they're all down from, about 3 to 17%. So a huge variety and not exactly what we're looking for from our best and brightest AI companies. Really, we've seen the market start to judge them on, one metric, and it's how much are you beating AI revenues versus how much are you coming in above CapEx guidance. So investors don't really have tolerance anymore for increasing CapEx without a commensurate increase in revenue. So you can't say you're spending more if you're not proving that it's making you more. And, this earnings season, we saw about double-digit sell-offs for each company that reported a higher CapEx surprise than they did an AI revenue surprise. I think it's not just about how much money are they spending anymore. There's some really real concerns about what are they getting for what they're spending. So one thing we're starting to dive into now is how is the unit of compute per dollar of CapEx evolving? And it kind of looks like we might be having some trouble where some of the CapEx increase is actually just about supply chain costs going up and not necessarily about bringing on more compute, which is not good news for ROI. It is good news for the entire AI supply chain. And so we're starting to see really strong results from companies that typically sold commodities. They sold memory chips, and we're seeing huge, unbelievable price increases in a very commoditized area. So from that perspective, it's a lot of the broadening out of the AI trade that you talked about as we get more concerned about this ROI. That was obviously a lot, but I think when we think about the AI supply chain and memory specifically, actually one area that comes up all the time is Asia. So, AI is broader than the US, but also as you think about the rotation we've seen last year and this year, how is international coming into all this?
It's interesting because it is one of the areas where you haven't seen the rotation out of it this year. So just as everything is shifting as the mirror image of what was going on last year, in international you had double-digit outperformance in most of the major regions relative to the U.S. last year. And that actually hasn't stopped this year. The U.S. still is lagging behind most of the major regions in the major markets. Now, one of the best performing areas is emerging markets. And it is related to what you're saying around AI and the AI supply chain. Because you look at some of the top performers in emerging markets, it's not necessarily the usual suspects.
Yes.
Areas like India are actually slightly down, even though they're massive earnings growers. Areas like China, that was a big AI piece of the story last year that has cooled off a bit this year and continues to be beleaguered with a lot of general macro challenges. But then you look at areas like Taiwan, Korea having another double-digit year, and that's that memory piece, that's the AI infrastructure, hardware piece of it as well. So that's what you're seeing not only drive EM returns, but the fact that EM returns actually have a compression in valuations so far this year, and all of that return pretty much is coming from earnings growth, is really that AI story there. But you look across other pieces of EM, and you're seeing areas like Latin America also do well. I do think that's implicated in the AI story because if you think about commodity intensiveness of AI and that build out, that's where that's showing up. But even more broadly, you see some of the less usual suspects within EM doing well in parts of the emerging Middle East and also emerging Europe. And I think that there's just generally a reasonably favorable macro backdrop. You have interest rates in a decent place. You have inflation for the most part in a decent place. Growth is looking strong. And again, the dollar has this general likelihood of falling a little bit more. Probably not as violently as we saw last year. And while that was not the sole driver of returns last year, it helped. And more broadly, certainly within emerging markets, just having that weaker dollar environment tends to be a positive. So a number of different factors. Again, some of them are cyclical. Some of them are valuations returning back to normals, dollar lower. But there are a lot of genuine catalysts, and AI is a piece of that.
Yeah.
A lot of the fiscal spend is as well. You see that in Europe. Japan's also one of the better performing markets this year.
Yeah.
Maybe bonds and currency are a little bit more challenged. But on the equity side, you're still seeing some strength there. So a lot to like within the international complex. And I think there's some room to run.
Yeah, and I also think one thing that's interesting, you kind of talked about value versus growth in the U.S. Maybe we're finally seeing value come back a bit, but pretty, historic outperformance for growth. That's not necessarily the case internationally. So as investors kind of think about how can we diversify away from some of that U.S. tech, understanding that not only is international outperforming, but sometimes the exact areas that can be a hedge to some of this tech are outperforming.
Absolutely. You're seeing that everyone's playing to their strengths. The
Yes.
U.S. continues to focus on technology. But areas like Europe, Japan, again, emerging markets are playing to their strengths, which is cyclically oriented, value-oriented types of companies that, as you point out, are having huge outperformance. So it's not just the AI trade permeating to other areas.
Yeah.
Certainly it is in pockets, but you're also seeing that general cyclicality in terms of areas like industrials and banks are having success in a lot of other parts of the world, which is a diversifier both
Yes.
geographically and sector-wise. We also have fourth quarter earnings season wrapping up here in the U.S., gives us a full look at 2025 and a bit of a look into 2026 and expectations there. What are some of the key highlights and dynamics that you saw coming out of earnings season?
So headline results have still been really strong. We're seeing, double digits in 2025, and we're expecting double-digit EPS growth in 2026 again. I would say the broader tech complex is still driving about 60% of that. It's a lot, but it still leaves 40% for the rest of the index. So it's not just tech that's doing well. And when we look at 2026, a lot of that is the monetary and fiscal stimulus that you mentioned. So sort of those cyclical tailwinds helping to not only support the consumer, but also maybe boost manufacturing activity, which has been a weakness. But then also there are some secular growth stories that are really driving returns outside of AI. I would say the biggest one has been financials. So outside of the technology sectors, the biggest contributor to earnings growth is financials. It's about the consumer still hanging in. It's also about deregulation, but it's mainly about capital markets activity. So higher markets drive asset management and wealth management fees, and more IPO and M&A activity drives investment banking fees, so that should continue into 2026. And then we also have a couple other industries that are really benefiting from secular growth stories like aerospace and defense, as Boeing and Airbus finally start to ramp production. And then also in pharmaceuticals, as companies start to focus on really high price specialty drugs like GLP-1s or treatments for skincare or IBS, really widespread conditions, is helping returns there.
And let's dig in a little bit more into the consumer, because one of the things that we do every quarter is we write this earnings bulletin.
Yes.
We focus on a fun thematic topic, and the K-shaped recovery has been a big topic among consumers in terms of high income versus low and middle income. But what people haven't delved into as much that you did is around the generational consumer. So talk to me a little bit about what you have uncovered about the Gen Z consumer, not only in terms of what companies are saying about their buying habits, but what they are feeling in terms of their own financial situations.
Yes, so for reasons you may be able to guess, I am particularly interested in Gen Z consumers. And you perhaps are particularly interested in millennial consumers. But I think it's starting to be more of a focus for companies. If we think about the K-shaped economy, we've really seen it highlighted with, lower income versus higher income consumers. But we also have, unique trends driving younger generations that are incredibly important for companies to be aware of, as we think about that's where really all the spending growth is coming from. Maybe Gen X and baby boomers are quite established, so they're spending a lot of money, but they're not necessarily growing that spend. It's younger consumers in the earlier phases of their lives as they start to deal with, first apartment, house, kids, their responsibilities, kind of expand exponentially, and so too does their spending. So companies really need to tap into that as a source of growth. And we've had some unique issues with younger consumers where for the first time ever, the younger generations are the least optimistic. So usually young people feel good and happy and, older people, excited about the future, and older people are more negative. Actually, now younger people are in fact more negative. So I think that is a concern because sometimes, we think about sentiment bleeding into spending, right? If I feel bad, I'm not going to spend as much. And then that's real trouble for the consumer companies who rely on that spending growth. That's actually not what we're seeing at all. So we see Gen Z and millennial consumers feel really bad, but they're still spending a lot of money, maybe retail therapy, if you will. So it's a very important source of earnings growth for consumer companies. And we see the things that are really driving growth for them tend to be the things that are tapping directly into Gen Z. So for example, the health and wellness protein craze really helping earnings in the otherwise very challenged food industry. Or makeup marketing on TikTok, helping otherwise challenged consumer packaged goods companies, and then also a real love of experiences. So we've continued to see very robust spending for travel and expenses, and even as people kind of want to pull back because they feel bad, they're leaning into simple experiences, simple luxury experiences like dining out or spending a lot of money at restaurants or cruises, winning at the intersection of value and experience. So a unique generation with unique spending trends that are becoming very important for companies to capture. Maybe I'll turn it to you for this last most frequently asked question we get on U.S. equities. How can we still be confident after 3 really strong years?
So if I think about what you're paying for when you're buying equities, and especially when they're as expensive as they are today, you want to think about that profit growth. You want to buy that future earnings stream. And what you've seen over the last couple of years is actually the rally, despite we've had 3 double-digit years in a row for the S&P 500, has gotten higher quality. Back in 2023, you looked at the composition between what drove returns, whether it was multiple expansion or earnings growth, and 27% of that return came from earnings growth. So it was basically a multiple expansion year, which is not unusual after such a harsh multiple collapse year that we had in 2022. But then you look at last year in 2025, and what you had was 84% of that return coming from earnings growth. So yes, valuations are expensive. They are on a very high perch, but they haven't budged that much. And in fact, they've come down a little bit this year during this rotation. And yet profit growth, as you've highlighted, still looks very strong for the year ahead. It looks like most sectors are in a pretty good place. Maybe some of the ones that aren't quite double-digit earnings growth for the year are just a hair under that, between 8 and 9%. It's really only the most defensive areas of the market that are not going to produce that amazing earnings growth. So you have that broadening out. You have a little bit of have your cake and eat it too between the Mag 7's earnings decelerating, but still to a 20+% growth rate. And yet the rest of the market is picking up to double digits. So you are getting that profit contribution, and it's coming from different places. So I think that's a huge underpinning of why you want to still feel okay about the stock market environment today and constructive on it. The other thing I would say is think about the basic drivers that we have at our backs here. And I talked about this right up front when we talked about the rotation, which is easing bias from the Fed, generally easier environment from a fiscal perspective, pretty strong momentum coming into the year. And despite all of this skepticism around AI, they're still producing amazing profits. They're still building for the future. So that micro story, I think, is still intact. So with all of those factors, maybe we still see a bit more volatility and there are risks and anxieties around a potential rally this year, but it should still be a relatively constructive backdrop, even if we're not seeing a double-digit year again.
It's hard to be negative on U.S. equities if we're expecting, call it 10% earnings growth or, really strong, probably double digits, and then plus a 2% dividend yield. It's just tough to be negative if you have that strong of a fundamental backdrop.
You get what you pay for.
Yes, you get what you pay
We're paying for a luxury good here with the U.S. equity market.
Absolutely.
Well, this was very fun, Katie. Great. That is all the time we have today. Thank you all for tuning into another episode of JP Morgan Asset Management's Insights Now, and we hope you join us next time.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed JP Morgan Asset Management or by other areas of JP Morgan Chase & Co. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable, but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions in current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.